This episode is brought to you by TruStage, an insurance and financial services provider built on the belief that a brighter financial future should be accessible to everyone, as well as the businesses that serve them. Their products and solutions are built to help people confidently make financial decisions that work for them at every stage of life. Visit TruStage.com to learn more. Hello, and welcome back to our new podcast series, Lending Unbundled, sponsored by the good folks at TruStage. In episode 1, my co-host Bjorn and I discussed how the structure of the consumer lending ecosystem has evolved to become both more efficient and more fragmented. We were extremely fortunate to be joined in that discussion by Rodney Hood, former acting comptroller of the currency and chairman of the NCUA. In episode 2, today's episode, Bjorn and I wanted to drill in on the consumer side of the equation. What does it mean for consumers that lending is now both more efficient and more fragmented? How do they experience those structural characteristics in their everyday lives? How does their access to credit, and in some cases lack of access, impact their overall financial health and resilience? How does it affect their outlook on the economy and their confidence in navigating an uncertain future? Well, as a financial services consumer myself, I have my own personal opinions about these questions, and Bjorn has his. But we wanted to do something more concrete than just offer our own personal anecdotes. We wanted data. So we switched on our financial health network bat signal and summoned Taylor Nelms, Vice President of Research and Insights at FHN, to the podcast. In our conversation, Taylor, Bjorn, and I talk about the gap between consumers' finances and feelings, the impact of different liquidity products on financial health, the fading confidence in insurance products, and a whole lot more. I'm really excited for you to listen to our chat, so let's get right into episode 2 in our series, Lending Unbundled. Okay, Taylor Nelms, thank you so much for coming back on the podcast.
My absolute pleasure. It's great to be here again.
Well, we are absolutely delighted to have you here. We are going to talk about the divergence, I suppose you could say, between different metrics that look at consumer financial health, consumer confidence, consumers' ability to access credit products. You know, it's interesting. We have been talking a lot in this series about the sort of new reality we find ourselves in 2026, where consumers kind of simultaneously have access to an incredible variety of different credit products, different options available to them, while at the same time having to deal with and navigate a great deal more complexity. And I want to sort of continue to drive this idea of like a divergence between things and consumers kind of being caught in the middle. And the thing I want to focus on a little bit today is the divergence between consumers' kind of economic situations versus their perceptions of their economic situations. The term vibe session has been used at times to describe this idea. I've seen recently that there might be some questions about the validity of vibe session as like a economically rigorous concept, which I suppose you might gather that from the name vibe session. Shout out Kyla Scanlon. But things that we do know are that, overall U.S. household consumer confidence is about as low as it's ever been based on the different surveys and indexes that look at this. And that bumps up against a couple of things, Taylor, that we wanted to ask you about. One is that according to a lot of just kind of top level kind of economic metrics, the U.S. consumer is still doing fairly well. And so it's been noted many times that that divergence between confidence and overall kind of macroeconomic conditions is interesting. But I want you to add another layer on top of that, which is consumers' financial health, which is obviously the thing that you guys study at FHN. And I think in some ways that might be the way to square the circle a little bit here, because, to me, perception of financial health is not quite looking at like top line economic metrics, like how many jobs have we lost? What's GDP doing? Like that's a little too abstract, but it also is not quite as sort of squishy as just like what is your general level of confidence in the future, which is also like kind of a hard thing to pin down. And to me, the research that you guys do into households' financial health blends together a bit of both in the sense that you're asking about more tangible things about a household's finances and financial situation, but you're also grounding it in surveys and to a degree sentiment and how people are feeling. So can you kind of help us square the circle on this? Like where are consumers in terms of confidence and the overall state of their financial health?
Yeah, thanks so much for this question, Alex and Bjorn. And again, it's really good to be here. Uh, Look, I mean, I'm not going to debate the idea that the vibes are weird. And so, I think it is a complex question. And I think it's complex because we really don't want to collapse macroeconomic data, consumer sentiment data, and the microeconomic realities of household budgets. And I do think that those are three different things. And
Totally.
you pointed to that, Alex. And so I think that that's right. So maybe let's start with what at the Financial Health Network we know best, which is financial health. Just some foundation laying. We believe at the Financial Health Network that a household is financially healthy when it's able to meet its current financial needs and obligations, when it's on track to meet future financial needs and obligations, and when it can absorb and recover from unexpected expenses or drops in income. So basically, can you make ends meet and stay on track in the face of setbacks? And that is a different set of self-reported data that we collect via surveys than how do you feel about your future? And it's really different from how do you feel about the state of the economy or the future state of the economy, right? Which are also those are also really, really different. So we measure financial health by looking at self-reported household financial circumstances across a bunch of different indicators, including things like cash flow and on-time bill payment, short and long-term savings, credit access, debt manageability, adequacy of insurance coverage, all of those kinds of things. And by our measures, fewer than 1 in 3 U.S. households are financially healthy, fully financially healthy. And I think what's interesting there is that's been actually remarkably consistent over the almost 10 years that we've been collecting data on household level financial health, right? The share of households that we classify as financially healthy has hovered right around 30% since 2018. It went up a little bit during the pandemic. And, we see that as directly correlated to forced savings and influx of income associated with government payments and other things. But really, it's kind of fallen back down to that plateau. So we see it as kind of stuck at that population level. Sometimes when you look under the hood, the drivers of those financial health outcomes move in different directions, right? So after the pandemic, for example, we saw confidence in people's ability to meet their long-term financial goals kind of waver. And confidence in insurance coverage in particular has been on a downward slope since 2018. But we see improvements in other measures, right? Like on-time bill payment and short-term savings. And so what's really interesting is that I think when you look at the differences in drivers underneath the hood, and then the second point that I'll make is again, at the population level, financial health looks pretty static, right? This percentage of the country is relatively financially healthy. This percentage is kind of coping, and this percentage is truly vulnerable. But at the household level, when you look at individual households, and we have a great longitudinal sample that allows us to track year to year, it's really dynamic. So between 2024 and 2025, about over 30 million households, about a quarter of households in the United States, saw their financial circumstances change enough that we reclassified their financial health tier, right? So they went from healthy to coping to vulnerable, or vice versa. So that movement, I think, means that there are real moments when people need help and real opportunities for organizations to show up with the right products and services at the right time. Let me just go back to this question about sentiment. I mean, financial health, the way that we measurement is not a macroeconomic indicator.
Right.
It's related, right? Like jobs matter, prices matter, but how they matter for individual households is really complex and variable. And averages, I think, can conceal as much as they reveal. So even when we look at macroeconomic indicators like unemployment or GDP, when those look stable, the microeconomic reality for households can be stressed. And a good example of that is like while income is really strongly correlated with financial health outcomes, we actually do see financial health challenges across the income spectrum, right? So it's not just about not having enough money, although that's really important. And similarly, financial health is like not a consumer confidence or consumer sentiment metric either. Although, of course, there's a relationship. We could talk a little bit more about this too. Um, Household finances is like one input, I would say, into how people feel about their economic circumstances, and in particular, how they feel about the economy. Um,
Right.
and inversely, how people feel about the present and future of the economy that can shape their perceptions of their current financial state. And it can also impact their, in material ways, their decision making, right? And we
I was
know
going to
about
say it
precautionary
impacts their
savings.
choices. Yeah. Yeah.
Yeah, it influences them to spend more or to spend less or to save differently. So I do think we're talking about three different things.
I couldn't agree more. And you touched on a bunch of different ideas there that I think are really interesting. I mean, I'm glad you sort of framed this third bucket as kind of like the microeconomic lens, right? Like looking at households and what they self report about the current state of their finances, their ability to handle shocks or things happening in the future. I mean, two points I want to dig into, right? One is the point you made about the overall number staying relatively steady over the 10-year period, but lots of movement within, right? So it's like not people stuck in these tiers that they can't get out of, but rather people moving up, some people moving down, and it keeps the overall picture looking the same, but the population movement within that large sample is very variable. I want to circle back to that, but before I do, Bjorn, I mean, Taylor said insurance. I like jump on it. Like what I know, like confidence in insurance. That's something that I've noticed in the FHN data as going down, and I think maybe the three of us have talked about this on a podcast before. But I'm really curious about what like confidence in insurance indicates, because I think there's like a narrow way of interpreting that, which is like I don't think my coverage for this specific risk is sufficient. But there's also like a macro sentiment way of, I think, analyzing confidence in insurance products, which is like the more volatility and uncertainty there is in the macro picture that I'm sort of perceiving, the more I might express that through a lack of confidence in insurance products. Bjorn, how do you think about that particular finding?
I think there are multiple ways to look at that. And I think about it in probably three areas. One, am I confident that I'm covered enough? Two, am I confident that the coverage I have will provide me the stability that I'm looking for in the worst case scenario? And then three, is the coverage I'm buying from the provider I'm buying it from actually going to yield any sort of benefit? Right. And what I mean by that last one is probably the scenario that most of us, and probably I would assume most listeners, have incurred at some point during their life is I pick on health insurance because it's the easiest one to pick on. And we don't deal in health insurance, so I'm not actually, I don't have a stake in that game.
Yeah.
And that is, you have something come up and you're wondering, is my insurance going to pay for it? Yes or no? And in most cases, you only know after the fact. There are some scenarios, of course, that you can go in up front and request, permission to have a certain surgery or a certain procedure done or something like that. But in a lot of cases, it feels that consumers are looking at it and saying, it's great that I have insurance. It makes me feel warm and fuzzy on the inside. But if push comes to shove, is my insurance provider actually going to pay? And I think that confidence ultimately comes from trust. And we had this conversation yesterday with a government organization, I won't name a name, where it was around insurance, related to lending products. And as an example, in that conversation, once they realized that TruStage is a mutual insurance, therefore has not the profit picture in mind, but the status, the member itself, right, and their benefit and all the comfort levels, going back to what you said earlier on the trust. All of a sudden they realized, oh, TruStage, yes, you renamed yourself from CUNA Mutual to TruStage, but you're still a mutual insurance. Oh, that makes me feel better, because there's a higher likeliness that a consumer is looking at it and saying, hey, if a member-driven organization has me in mind, therefore maybe I feel there's a higher likeliness that they're paying. If that actually is going to happen is a different question, right? But at least from your confidence perspective, there is a direct correlation, in my opinion, between what we see nowadays in our organizations profit-driven, or are they not?
Yeah, I think that that's such a good point. When we ask folks about their confidence in and their insurance coverage adequacy, right? I think it proxies a little bit on risk tolerance, right? Some folks are a little bit more comfortable with less coverage than others. But I also think that there's a big information gap here. And some of that is structural and kind of built into the incentive structures of the various insurance markets that we're talking about. I mean, just to your point about, even if you have insurance and feel like you have the right insurance, like, will it actually cover you in the case of an emergency? I think there was a Wall Street Journal article maybe last month about home insurance specifically that suggested that, found that the among the 5 largest U.S. home insurers, just a little bit less than half of the claims for those home insurance claims for those insurers were closed without a payout. So it feels like a coin flip, right? Like, even if you have home insurance and even if you feel like you're covered, it feels like for many homeowners, a coin flip about whether or not that's going to cover you in the case of an emergency. That's true for health insurance. I think it's true for lots of different kinds of insurance. And so the question is I think becomes this one of, what will drive consumer trust in coverage, not just can we get them access to the right coverage.
Yeah, I mean, it's a fascinating kind of product design question, because, I mean, as we all know, like, insurance is fundamentally like risk transfer. And so, like, the more risk you can pool together, the more effectively you can transfer it and price it. And so I think that it's a strange thought I'd never had before, but like, the dynamics of how you manage insurance from a risk perspective sort of force you to like make it as big as possible. Like, that's why we have these big categories like health, home insurance, like these very large things. But I do wonder if the flip side to that, Taylor, is like more, not to use a pun on your own name, but more tailored insurance products that are more specific to different risks. I think that's the other thing that, and this goes back to something you mentioned before about different segments of consumers, like low to moderate income households versus higher income households. A thing I always sort of notice is that like at higher incomes, there's just a more like bespoke set of tools available to households to like manage risk and to do things. And so, like, higher income households tend to think more in terms of like hedging risk and what instruments can I use to do that. And that's like more specific. Whereas it feels to me like as you go down market to kind of lower and moderate income households, the tools become like kind of more blunt and broad and like harder to understand from an information perspective, and maybe just less like reassuring in the sense that like I as an individual am worried about this specific risk, but I can't find a product that speaks directly to how I protect that specific risk and gives me confidence that it will work. So I wonder, and I don't know if this showed up in your data at all, Taylor, but I wonder if there is a bit of a segment difference in feelings around insurance products, because it doesn't feel like everyone gets access to exactly the same tools in this respect.
Yeah, I don't have the data right in front of me in terms of kind of segmenting out perceptions around insurance by population, but we certainly have that data, and it would be really, I think it would be really interesting to look at. The point that you're making around complexity, I think is a really good one too, and I think we can talk a little bit more about this later, but I do think that the growing complexity of the financial services market, no matter what product category we're talking about, it does present outsized challenges and burdens for the underserved, the marginal, or financially vulnerable, for a whole range of reasons. Like, one of them is the material buffer, right? That just simply having more financial resources like provides for you. But it also is about the fact that there's exacerbated risks, right? And less time to plan and navigate for them, right? So with that that scarcity problem produces these psychological effects. And those show up, I think, in the confidence data. I think that they show up in trust. We can talk a little bit about some of the work that we've done on trust recently. And they certainly show up in very like classic kind of behavioral economics ways in the challenges that scarcity presents to planning and decision making, right? Like, we're just not good decision makers when we don't have the time and resources to make them.
Yeah, well, and time being just as important or more important. I mean, I always think about, the more sort of financially stressed you are, the more you're just spending time mechanically on things that otherwise might go to like longer term planning or consideration or more shopping or just a whole set of those downstream behaviors.
Yep. And, I mean, I think the good example of that is if you're talking with like a financial planner or a financial coach, like one of the very tactical pieces of advice they'll give you is like, don't make decisions late at night.
Right.
Right? Because you're tired, right? Like, you shouldn't
Totally.
be shopping for anything late at night. I tell my mom this all the time. And like, make your decisions in the morning when you're fresh, right? Like, hopefully after a good night's sleep. But I just think that speaks to the value of time, right? And being able to sort of positively shape decision making.
Absolutely. One of the things, circling back to what you mentioned about the sort of distinction between overall levels of financial health staying relatively steady, but lots of movement within that population for different groups becoming more or less financially healthy and financially stable. I'm curious to sort of contrast that with, like, it's interesting. Over the last 10 years, that's barely budged. And yet we've seen an explosion of products that are sort of ostensibly designed to try to solve this problem. And so I'm curious, Taylor, to maybe understand in a little more detail, like, what are the drivers? And you mentioned some of them before that tend to kind of ebb and flow at different times. But when you look at things that have moved people either up in terms of their overall kind of financial health and like level of financial stability, or have moved them down within that population over the last 10 years, can you sort of like overlay that on top of all the fintech innovation that we've seen over the last 10 years? Like, what actually helps, what hurts? Because I mean, the focus of this episode is obviously like consumer lending. And I mean, you and I have talked about this before. We've seen just an explosion in the number of different like credit and lending and liquidity options available to consumers. But is that helping? Is that hurting? Like, what's the impact?
Yeah, it's a great question. I do think that there has been an opening in terms of a market opportunity for short-term liquidity solutions. And I'll talk a little bit about how I see that landscape in just a second, but I think that that's responding to the dynamism in terms of people's financial health around earnings volatility and expense shocks. And that's two sides of the same coin to some degree. But I think what we have seen, there's really good research. There's a great 2025 paper from NBER on earnings instability that uses administrative payroll data. And it shows that, volatility for workers is really the norm, not the exception, right? And it's structural. It's not a choice, right? And so most US workers, in fact, see pretty substantial month-to-month pay swings, even within the same job. And so it's not just about like gig workers losing their hours. It's really driven by a growing volatility in the labor market, in terms of how people earn, how people make money. Folks just have lumpy income. I think that this poses real economic risk, but I also think that it really directly shapes what are the financial health needs that a household has. And they have a real product need to help smooth volatile income. On the other side of the equation, I mean, expense shocks are extremely common, right? So like in any given year, 7 in 10 households will report experiencing a significant unexpected expense shock versus 3 in 10 that report experiencing a significant income shock, apart from just regular volatile income. So I think that like this combination of expense and income shocks like produce a pretty highly variable cash flow experience for most people in the United States. And I think it's opened up these whole new realm of market opportunities when it comes to short-term liquidity solutions. When I was looking at the landscape, I really see these solutions as falling into a few different buckets. There are some like cash-based solutions, right? So like products that encourage people to save for an emergency fund, right? A rainy day savings. That's often increasingly offered as an employer-sponsored or payroll-linked benefit. And so it's important to look not just at like the strictly financial services providers, but at that broader employer landscape as well, and the way that financial services is getting embedded into the employment space and the benefits package. So like that's one set of solutions. The second set of solutions is lending, right? And the kind of growing variety of small dollar credit products or credit-like products that are designed to either directly bridge a gap or just help people manage their spending. And that includes everything from buy now, pay later and earned wage access, which people talk a lot about, to interesting like employer-sponsored loan products, right? So I know a lot about like Rhino Foods Income Advance program, which is this program in which the employer, in partnership with the credit union, offers small interest-free or very low interest loans repaid through payroll, or like Cashable, which similarly offers like low-cost loans to employees. So like that's another set of solutions that I think is addressing this variable cash flow financial health need that people have. And then the last one is maybe a little bit more like insurance in the insurance space. And here, you've got this kind of newer model emerging where people are paying a small monthly fee and they can then draw on funds when an unexpected expense hits. So like Rainy Day Pal is an example. It's employer-sponsored subscription that pays out, again, for unexpected costs, explicitly structured kind of as coverage rather than as a loan. I think what all of these things have in common is that they are designed to meet these like short-term liquidity challenges. But to get back to your original question, they tend to be utilized by people who are already experiencing financial challenges. So the way that I look at this market is, these are bridge solutions. They're not really solving for that underlying issue of inadequate income or variable income alongside regular unexpected shocks in spending.
Yeah, I mean, Bjorn, I'd love to get your thoughts on that as well, because I mean, obviously you guys at TruStage play in one very specific part, which is disruptions to income, but that is like one part of a larger set of considerations. I mean, there's disruptions to income in terms of like job loss, disability. There's also like more just sort of routine disruptions to income, which is like not getting as many hours or getting as many shifts, or just like less demand from this side hustle or whatever that disrupts income, but in a more subtle way. When you talk to like either lenders or to others who are kind of looking at this, Bjorn, where do you see the most sort of like stress being placed on consumers?
That's a pretty tough question, I think. I think to Taylor's point, I think it's all over the place, quite frankly. And I think you can create groupings based on different demographics and like subgroupings at a micro level versus a macro level of saying, okay, we've seen, U.S. government workers with TSA, with all the different things that are happening in Washington D.C. of ups and downs, and that causes, economic stress on on those consumers, maybe for a long period of time, sometimes for a short period of time. To your point, am I getting the right numbers of shifts, right? TSA is just a major example of that shift problem in a very finite group of people.
Yeah.
And I think in the end, when looking at it from the highest level, from a macro perspective, it comes back to the point that I think over 80% of US households have major concerns when engaging in some sort of a loan transaction of what is that financial stability. We talked about it on a previous podcast, and I bring this up every time because I think it's a real interesting question, which is, are you getting a loan to become financially stable, or do you have to be financially stable to get a loan, and then it's just supporting it?
Yep. This episode is brought to you by TruStage. If you're a fintech lender leaving non-interest income on the table, TruStage payment protection solutions are designed to change that. They offer compliant, scalable protection directly within the lending experience, helping improve repayment outcomes without adding operational complexity. TruStage member insurers have helped people make sound financial decisions for over 90 years, and that same thinking shapes how they build for lenders. Visit TruStage.com to learn more. It's a great, it's the constant chicken and the egg problem. And I think going back to Taylor's point, like what we have developed are a set of more targeted liquidity solutions that are sort of designed to fit in these gaps. But it still a lot of times ends up in that chicken and the egg thing where it's like, okay, are you taking this in order to sort of take a positive step forward in terms of your financial health? Or are you taking this because you've already taken a step back and you're trying to sort of like staunch the bleeding? And I think it's hard when you I spend a lot of time talking to fintech providers about this stuff. And, they all aspire to be the product that's used only by people who are like trying to like take a positive step in a direction. But you can't necessarily dictate like how your product is going to be used, which I think is another element to this that Taylor, I know you think about this a lot. Like, is BNPL bad? Is BNPL good? Well, it's like the answer is it depends a lot on the context in which it's being used, how the product is being positioned, how much it's being made available to different segments of customers. Like, it's hard to say definitively. And that's why the question I asked you before about like what's driving this dynamism within that financial health number is a hard one to answer. Is it all really depends on the circumstances and how these products are used.
Yeah, that's exactly right. I think the bigger point to just remember is like nobody's trying to harm their own financial health.
Not at
right?
all.
Like
no.
Everybody is trying to like be more financially healthy. What they're really trying to do in those moments of shock is bridge the gap, right? Like they're trying to solve a problem. And so some folks, I think, have access to a range of solutions that allows them to do that in the short term while setting themselves up for success in the long term. And other folks either don't have access, don't know about, or are just like not positioned to take advantage of those options that are able to align short-term problem solving with long-term financial health, stability, and growth. I also think that, like we mentioned this earlier, but I'll just come back to it here. There's an intervening, a lot of what we're talking about is kind of like confidence in borrowing, right? Like, are people confident in their own ability to borrow? Obviously, that differs around like what kind of loan you're talking about, right? Like confident, like mortgage readiness is like really different than confidence in your ability to repay BNPL, right? Just entirely different markets and entirely different psychologies. But I do think that like one thing that's common across those situations is this factor of trust, right? And so we've started to look at how does trust shape people's interactions with providers. And I think what's really interesting is we tend to think that the US financial system is like pretty trustworthy. And indeed, I personally think that, like, for the most part, it is. But we found that nearly 4 in 10 Americans feel uncertain, hesitant, or outright skeptical about the financial system overall, right? And that's even more different when you're talking about like Black Americans. Over half feel that way, or Latino Americans, again, similar rates. Financial, like, trust in financial institutions varies really sharply across demographics and in terms of what kind of trust we're talking about. So again, like, we asked people, how much do you trust that a financial institution can keep your deposits safe versus how much do you trust that financial institutions will give you good financial advice or even want to help you improve your finances? And as you can imagine, I was surprised, actually, that we're still talking about over a third of Americans who either don't trust or are somewhat skeptical around a financial institution's ability to keep their deposits safe. But that level of
flag
trust,
that for the FDIC. By the way,
I know,
like,
it's really
just
not
watch
great.
out. That's a high number.
It is, but that's lower than rates of trust and distrust around like financial institutions' ability to give good advice or improve your finances. So, as we think about like this question around what are the psychological factors that are shaping people's willingness and ability to access financial services, especially lending solutions, there's confidence in yourself, but there's also trust in the provider, right? And I think we have to look at both sides of that equation.
I think that's such a good point. And just to maybe narrow in on that a little bit, because a theme of this series is the sort of modularization of a lot of financial services. I'm curious what your opinion is, Taylor, on how complexity sort of factors into trust. And just to put a little bit of context around this question, I'll pick on Synapse and everything that happened in banking as a service a couple of years ago, because I think structurally it's kind of a representation of just how complex the financial services ecosystem has become. Like, the level of complexity to how banking as a service relationships work relative to how much of that complexity is like visible or easily understood by the end customer is just wildly different, right? Like, to the customer, it appears, hey, here's this digital finance app, here's this tool that you can use that will solve this specific problem. But under the surface, just heads up, there's a great deal of complexity. You're actually working with 19 different entities that are regulated in different ways, and your money is being passed between these places, and it's being put in an FBO account. But don't worry what an FBO account is, because insurance will probably apply to it, but maybe it won't. But we'll find out if we fail. Like, it's very, very complex. And what's fascinating to me is, for obvious reasons, providers go to great lengths to try to conceal or abstract away that complexity, because, like, you don't want, it's like the terms and conditions thing. Like, you don't really want the customer reading the terms and conditions, because if they really knew how the sausage was made, like, they really wouldn't want to eat it. But it is also inescapable that at times that complexity surfaces for customers, right? And just some examples that occur to me are things like, obviously a catastrophic failure like Synapse going bankrupt. Suddenly a bunch of people learned what FBO accounts were when they didn't necessarily want to know that. But even like in this series, we've been talking about, the fragmentation of the lending ecosystem, where it's like, yeah, I got my loan from this fintech company, but it was originated by this bank, which I saw when this disclosure popped up, and then it was resold to this other company over here. And like, there'll be these points where this like complex system we've built under the surface sort of surfaces and makes itself like visible to end customers. I think even something simple like, I thought I was getting a loan from like a company that's sort of like a bank, but when I look on their website, there's no phone number that I can call if I have a question. And of course, the answer is like, this is a tiny little fintech company that only has 20 people working for it, and they don't have a call center that you can call. So I guess I'm curious, how do you think the complexity of our current system impacts like perceptions around trust?
Oh, this is such a good question that we don't actually know the answer to, and we need to know the answer to it, right?
Totally.
But I'll provide my own my own personal perspective, my own take.
Yeah, please do.
I mean, I think that like unbundling the stack, right? I think was really useful for efficiency, right? Like it allowed companies to specialize and get good at doing like one thing well. And I think that that's true. I do think, to your point, that we may be seeing some unintended consequences of that unbundling. And I think these are hypotheses rather than like, I definitely think these are true, but I think that they're good hypotheses for us to investigate. Like one is, and you just mentioned this, I think unbundling the stack may have removed or created roadblocks for the customer relationship feedback loop. And so that's when that complexity surfaces in customer service, interactions, or when somebody wants a customer service interaction and aren't able to get it, right? So like we've created this like pretty vertically integrated relationship transaction with this highly siloed modular kind of assembly line thing. I also think, or I guess I wonder if this unbundling, this kind of fragmentation of financial services might also have created some conflicting incentive structures.
Yeah.
Right. So I'm thinking about like, what is the underwriter optimized for? What is the servicer optimizing for? What is the funder optimizing for? And those are not always, or maybe ever, the same thing, right? And if that's the same organization that's doing those kinds of things, they can balance those incentives because ultimately it's like coming from the same place or going to the same place. It's cost or revenue. But if it's different organizations, now all of a sudden you may actually have some incentives that are going to affect the customer differently. So I think that's a big open question. And then, I also think that from the consumer's perspective, this was your original point, I think we're starting to see some friction up here, right? Where, in that vertically integrated model, like human involvement ends up being the like risk management tool of last resort, right? At the end of the day, at the very least, like we could get somebody on the phone, like maybe they can solve your problem. Like when the stack is unbundled, like the borrower, in this case, if we're talking about lending, is often left dealing with either like zero recourse, or if there is recourse, it's like very self-service or automated, right? So you're dealing with like the chatbot that like doesn't understand what you're trying to ask it. You're dealing with like automated collections. And I think that all of those things have the potential to really negatively impact trust. The last thing I'll say, which is how you started, is like to think a little bit about like the revenue model for the unbundling phenomenon. And this is just to go back to your point about fees, right? So we've been arguing for a long time at FHN that access to basic financial services isn't enough by itself to improve people's financial lives. Like the right lens is financial health outcomes. But that's precisely the thing that in this unbundled world, no one is accountable for or optimizing for. And so by turning lending into a little bit of a relay race, right, where every player is optimizing for their own little slice of the P&L, right, we've treated a situation in which borrower's relationship and their trust is this kind of like orphaned externality that nobody's actually paid to own.
Yeah, it's a great point, right? A way tying it back to the idea of insurance, and Bjorn, I want to tag you in here in a second. Like, it's interesting that the modularization of consumer lending kind of acts as like insurance for all the providers in the ecosystem, right? Like if I don't want this risk, I can just transfer it off my books to someone else. And so in some senses, we've created like a better safety net or more like efficiency and a more sort of like flexible system for the providers on the one side. But the cost of that is to the customer, who now doesn't have like a single point of accountability for outcomes or for resolving problems. I mean, I could list a litany of recent examples where a fintech thing broke, and because of the inherent complexity under the surface, you try to call the number and the number no one picks up, or you send an email and it's one person trying to respond to 10,000 emails and you don't get a response for 3 weeks. I mean, it really reveals itself to customers, and I think illustrates that in some ways we've optimized for the providers, but haven't optimized for the end customers in terms of this more complex modular ecosystem we have. Bjorn, one of the things I know you guys do at TruStage that's interesting to me is you try to design products that fit into this more modular, complex world, right? Like a product that can be embedded within sort of a third-party channel that's available to customers when they're getting a loan, a insurance product that can transfer across multiple providers and not just stay with one provider, but sort of be anchored on the customer. Can you sort of comment on just like what are the design considerations when building products that kind of have to fit in this more complex modular world?
I will try. I'm not a product designer by choice. I sell what others design that are way more intelligent than I am on that front, and maybe creative. But I would say you have to balance essentially 2 to 3, maybe 4 different aspects. One is, what would a consumer pay for?
Yeah.
On the flip side, what will a partner, or is it a financial institution, or if it's going direct to consumer, what can they sell and see as a value proposition for you? And then anything in between, to the point of what you said, can I make it easy to buy, but it becomes too expensive? Nobody's going to buy it. And am I making it difficult to buy, but it's really cheap? Still nobody's going to buy it. So you have to weigh all these things together. And then on top of it comes the complexity of regulations to ensure that you're not violating any regulations. And you also keep that trust by the consumer, because in the end, the consumer is going to pay, even if it is embedded in a charge. Like, I'll pick on an example like cybersecurity insurance.
Sure.
Every company has cybersecurity insurance, so somehow that is covered in overhead costs in every product that they're selling, right?
Right.
And other insurances like that act the same way, that they're embedded in the product. And so you have all these different things coming together for understanding regulation, keeping the consumer trust, having the ability to articulate a value proposition that the consumer can buy into, and making it affordable so somebody's actually going to buy it. Those are really difficult things to combine. And I go back to parts of, let's call it the last 20 years, we've moved a lot into digitization, which both created transparency, but it created a mess as well because of the fragmentation of services. You're like, well, everything's out there, but I have to look in 15 different places to get the data. I can't have my one person to call anymore that I did in the past. Now I need to know this piece is done by them, this piece is done by them, and the FDIC, the NCUA, the OCC all want transparency so the consumer knows what they're paying. But transparency can also be extremely overwhelming if you have too much information, right? You can, to your point with T's and C's from earlier, you can bury the good information and the bad information in a lot of information.
Yeah.
And that's, I think, those are all the different things we're trying to take into account when building the products. And then lastly, I think to a point Taylor made earlier, when it gets to financial stability and financial health, from an insurance perspective, one of the things that I think about it all the time is you have those short-term issues like an expense, like a massive expense that has happened, or an income loss or something. And the question becomes, were you ready before it happened, or are you getting ready for the next one to happen because it happened? And we saw that in cyber like 10, 15 years ago, when nobody wanted cybersecurity insurance or multi-factor authentication or change your password every 90 days.
Sure.
Until your identity was stolen. And all of a sudden you're like, well, I need to change my password once a week. I need to reboot my phone once a week. I need to do all these different things. And so I think to Taylor's point, across America and probably across the world, I always ask that question, are you doing enough to be ready for an event, whatever that event is? Or are you starting to get ready after it has hit you once and now all of a sudden your eyes are opened? And how do we as service providers help people to get ready for the first one by making solutions affordable, by educating them, by driving awareness out there, by continuing to have consumer trust, to have the transparency, all these different things. That for me is one big thing where until your insurance either pays out or doesn't pay out, how do you trust them that your money is invested appropriately? And so that's what we need to work on.
Yeah, I think that's, I mean, the point you make about like until the thing doesn't work and you sort of pressure test it, you don't really know. And it ties back to this theme we've been talking about with trust kind of cutting through everything. Taylor, you're a busy man. We need to let you go, but can we ask you one more question to wrap up?
Sure.
So just thinking about this sort of confidence gap that we've been talking about, and kind of the volatility and the just sort of uncertainty that consumers need to navigate, particularly in a more complex ecosystem as we've been describing. What's one thing that you would like to see lenders sort of design better for? And it could be something relating to the product, how they originate products, how they underwrite them, how they service them. But like if you could sort of push the industry in one particular direction to sort of address some of these concerns we've been talking about, what would be top of mind for you?
Yeah, it's a great question. I'll maybe kind of end this with like two calls to action. Like one
Please.
is, I'm a researcher. I have to say it. Like I said earlier, there's so much we don't know actually about
Yeah.
decision making in this particular fragmented environment with lots of uncertainty and lots of um, lack of transparency, kind of information asymmetry. So I actually think we need more good research that helps us understand how people are making decisions about which financial products and services to use in which situations. So like that's like one really, really important thing. The second thing I'll say is like at Financial Health Network, we've been committed to building out a set of product level standards for financial services that really center consumer financial health. And so as we think about product design, I think it's really important to keep in mind, like not just like let's design individual products that serve specific needs. We talked about that earlier and how that can result in this kind of like diversification of solutions that are useful, but that don't solve underlying problems. I think we need to have that kind of holistic industry-wide approach to understand how do we design for financial health outcomes and how do we kind of set the floor in terms of how industry operates with consumer financial health outcomes at the center of their decision making. But within that point about product design, I would say like for a lender, one of the things that's really important to keep in mind is like you're not just selling credit, you're selling certainty against volatility. And so I would like really, really center this idea that you need to design lending solutions with flexibility built in by default. And you can do that in a bunch of different ways. But I think that is like a really good design principle for lending product designers in particular. So, just for example, transparency can be really helpful, but to Bjorn's point, right, like transparency without simplicity is self-defeating, right? So when you provide transparency, think about like, how can we also simplify, right? Like, what are the fees that we can take out? What are the compounding penalties that we can remove? I think that we can also think about like the repayment process and how do we align that with the real way in which people are making money today, right? Which the monthly paycheck is like not it, right? Like the people's incomes are really lumpy. And so how do we design payment plans with flexibility so that people can pay when they have money, not, when the arbitrary due date on the on the loan agreement happens to fall in the month, right?
Totally.
So I feel like those are just some small examples, but I do think that designing with flexibility built in from the beginning is absolutely essential in this environment.
Yeah, I think that's extraordinarily well said. And again, it kind of goes back to this theme of a lot of the ecosystem that we have today sort of evolved to create more efficiency and more flexibility for providers, but we haven't necessarily always done that for customers. And returning to the customer side of the equation and building more of that makes all the sense in the world to me. That I think is a great place to leave it. Taylor, thank you so much for carving out the time for us. We really appreciate it. I had a hunch we'd go a little longer than I thought because, as always, bring a lot of interesting data and valuable insights to the table. We appreciate it.
Well, thank you very much for having me, and always a pleasure to be here.
Awesome.